The Nasdaq index lost over $1 trillion in market cap today. It was down almost 4%. It was the worst day since 2022. For the S&P 500, it was the first day down more than 2% since 2007. It's a really pretty rough day. So let's break down what happened and why, and what do I see in the future. So first up, why did this happen? The big news was Tesla. Tesla missed some revenue numbers. They had a really not great earnings report, and their stock tanked by 12% on the day. That's a pretty darn big deal, and that's 2.5% of the index. Going up market though, even larger companies like Apple didn't have a great day. When you look at Nvidia is off 7%. And then when you look at the three largest companies in the Nasdaq index, they actually make up 25% of the index. When you look at Microsoft, Apple, and Nvidia, 25%. So if any of those three have a bad day, the entire index is going to get pulled down. And I mentioned it's a cap-weighted index. Let's talk about what that means, because it has a pretty big impact on how the index what the index returns look like. Cap-weighted index just means that if there's 100 stocks in the index, instead of holding each of those 100 shares in equal amounts, so you have one share, $100 worth of Apple, $100 worth of Amazon, $100 worth of Google or Alphabet, instead their weighting is actually based on their market capitalization. So larger companies like Microsoft, like Apple, like Alphabet, which is Google's parent company, those are going to have a higher weighting in the index than a super small company. Kind of makes sense. It's pretty intuitive, but not all indexes are made like that. You can find indexes that are equal weighting. Alternatively, you have something like the Dow Jones, which is a really kind of odd index because it's actually based on share price. The weighting is based on the share price, not the market capitalization. And that's weird because share price and market capitalization aren't really linked, because you can have as many shares as you want essentially, and even if your share's worth, Berkshire Hathaway's worth 6 figures per share, if you don't have that many shares out there, you still don't have that much market cap. But that came about because back in the early 1900s, late 1800s, they didn't have calculators, so it was a lot easier to calculate the value of a price-weighted index or a share-weighted index as opposed to a market cap-weighted index. But that's neither here nor there. The point is, when you have a bad day, when any of the biggest stocks have a bad time, it pulls the entire index down. And what's really interesting is correlation. Correlation just means that if stock A moves, how much does stock B move? That's the simplest breakdown. Typically, when you look at the basis for modern portfolio theory, it's that we buy a very diversified portfolio. You own large cap, mid cap, small cap stocks, you own growth, and you own value. And then you also own international, emerging markets across the board, and bonds, maybe some commodities, all those different asset classes, because each of them has a different level of correlation with the other assets. So that way, even when one goes down, you'll find that something else goes up. What's really interesting is that, especially over the last 20 years, 30 years, as the market has gotten bigger and bigger, and as we've seen the level of computer interaction in trading, whether it's high frequency trading, whether it's large institutional investors, essentially what we're seeing is that correlations have gone up. And in times of crisis, if you look early 2020 pandemic era, the correlation goes through the roof. So essentially, the babies get thrown out with the bathwater. Even when nothing has happened to change the fundamental valuations of one stock, but because Tesla went down or because Nvidia went down, you'll see that correlation goes up and folks rush to the exits. They want to sell, they want to have safety. That's why we saw treasuries went up today. Treasuries went up for two reasons. One, it's an expectation that the Fed will cut rates in September. Right now, the market's betting about They're putting about a 90+% chance that the Fed cuts rates in September. But it's also a flight to safety, because when the markets get riled, they want to move money into something that's safer. And the U.S. Treasury bonds are about as safe as it gets. If we get to the point where those don't pay, we've got much bigger issues. So that's a little bit of it, but then sometimes it gets really crazy, like in early 2020, when stock prices fell, but Treasury prices also fell. And again, that's that correlation going up. When things really get crazy, I hope that today was a one-off. I can't say that for sure. I think the market's gotten overextended over the last 6 to 12 months, but I'm hoping today was a one-off. But when you have a market that really goes haywire over the course of a couple weeks or a couple months, that's when you see those correlations increase. So then looking forward, I mentioned that valuations have gotten pretty crazy. We're still seeing really high multiples despite having higher interest rates. And we're also seeing the issues I've talked about in my newsletters with commercial real estate. Blackstone cut their dividend today. That's a big deal. They're one of the biggest players in the commercial real estate market. Their BREIT had some issues recently. So we're seeing some weakness there, and it feels like the market's finally starting to price in all those potential issues that they've just kind of ignored for the last 6 months. The fact that the economy is slowing down, the fact that rates haven't been cut because inflation really hasn't dropped to the level that the Fed had hoped for. And that when the economy is slowed down and the growth is going down and the resiliency of the consumer is going down because we're running out of money. When you look at household savings, that's dropped. Household debt, especially revolving credit, has gone to new records. It's because people are tapped out. When you look at the price of food going up 25-30% over the last 4 years, that hits consumers in their pocketbook. Eventually, something has to give. Right now, it looks like the market's finally pricing that in, or at least beginning to. So where do I see the market going from here? I don't think we're necessarily going to have a lot more days like this, but I can't say that for sure. I don't have a magic 8-ball. That's not my thing. But I do think that it's a good time to take some risk off the table. I wrote about this last week in my newsletter, which you can sign up for at the link in my bio, that right now it's a time to play defense. You know, when it comes to money from my clients' investments, I'm here to protect their money, and I want it to grow. But more than anything, I want to make sure that they still have the funds they need to stay retired. And so take some gains. You've probably still had a good 2 to 3 years in the time since COVID hit. Your stocks have probably done pretty well over that time. Take some of that off the table. Take some risk off the table. Save it for a rainy day. If you have any questions, shoot me an email, jeb@plentifulwealth.com.